Industrial investments did soar towards the end of 2011. In particular, there were three big distribution portfolios that went into the marketplace. Distribution is often very popular with investors, particularly because you have long leases and good covenants. So there's a very, very strong cash flow which investors like to see coming into their pockets. At times like now, when income is king, distribution has proved to be very, very popular. For the first time last year, we saw a very significant increase in the amount of international capital that came into the UK and was looking for industrial investments. In particular, we saw Middle Eastern money, Far Eastern money, we saw South African money and quite a bit of American money coming in, really for the first time in bulk. Historically, the UK market for industrial investment has been domestic, but last year I think the statistic was about 1.9 billion of international investment came into the marketplace. This was up from 200 million in 2010. The UK domestic market accounted for about 50% of the whole market, whereas overseas you find about 30% of the market in France and 30% in Germany is domestic rather than international. So a huge increase in the UK. The industrial investment market is always popular. The reason being that it produces a cash flow which is generally higher than any other of the sectors. I think this year is going to be a good year for industrial investments. I think at the prime end we might see a little tiny slither of rental growth. We're already seeing it in patches of the southeast, particularly the Park Royal area. However, I am concerned about rents in some of the fringe areas of the UK where manufacturing is not as strong as it might have been and demand, particularly from the service sector for industrial units, is weakening. So I think it might be a game of two halves, I'm afraid. Good is going to be good, and I fear slightly for the secondary sector. Yield levels moved in last year by about 25 basis points in the UK at the prime end. And this compares with Russia, Moscow, which was about 50 bips, and Warsaw and Prague, where they moved in, I think, about 25 bips each. I'm not sure that there's a great deal further to go. At the prime end, the bond characteristics of the distribution warehousing sector of the market are being pretty fully explored at the yields of 5.35, which I think was the top deal last year for a distribution warehouse in Dagenham. So I'm not sure at the prime end there's much further movement to go. Where you've got secondary markets where rentals could fall, I think yields could still move out quite significantly. So secondary, tertiary, be wary.